In early 2025, U.S. President Donald Trump announced a 25% tariff on Canadian imports, citing concerns over illegal immigration and drug trafficking. In response, Canadian Prime Minister Justin Trudeau and Ontario Premier Doug Ford considered retaliatory measures, including reducing energy exports to the U.S. and suspending liquor imports. Given the deep economic interdependence between the two countries, particularly in energy, such actions could disrupt supply chains, increasing gasoline prices in the U.S. and causing economic difficulties for Canada's energy-reliant provinces. At the same time, China significantly reduced its imports of U.S. crude oil, dropping from 115.6 million barrels the previous year to 81.9 million barrels. This shift stemmed from China's economic slowdown, a transition toward renewable energy, and increased imports from Russia and Iran. In retaliation for U.S. tariffs, China imposed a 10% levy on U.S. crude oil and a 15% tariff on liquefied natural gas, LNG, and coal, effective February 10, 2025. While U.S. energy exports form a modest portion of China's total imports, these actions further strain the U.S.-China trade relationship. China's shift away from U.S. oil is part of a broader realignment in global energy markets. The country has long diversified its crude suppliers to secure favorable terms. Recent data shows China's overall crude imports fell by 7.2% year-over-year due to sporadic COVID-19 lockdowns, abundant domestic reserves, and planned refinery enhancements. China has restructured its purchasing strategies to obtain cheaper oil, deliberately reducing reliance on Western suppliers. Countries under U.S. sanctions, such as Russia, Iran, and Venezuela, have benefited from China's shift. Facing Western sanctions, Russia has offered substantial discounts on its Urals-grade crude, making it an attractive option for Chinese refiners. Similarly, Iran has continued shipping crude to China through covert methods such as disabling transponders and conducting ship-to-ship transfers near Malaysia. Venezuela, despite American sanctions, still exports oil through complex payment routes, making its low-cost crude appealing to smaller Chinese refineries. By prioritizing discounted oil, China secures lower domestic fuel costs, enhances refining margins, and boosts exports of refined products, particularly within Asia. This diversification strengthens China's energy security by reducing dependence on any single source while expanding trade relations with sanctioned nations. China's move towards cost-effective suppliers influences global oil pricing and trade patterns. As the world's largest crude importer, its shift forces established suppliers, including Saudi Arabia, Angola, and Brazil, to reconsider pricing and supply routes to maintain market share. This trend also undermines Western sanctions, as embargoed oil continues to flow through alternative channels. Additionally, China's increasing reliance on Russian oil poses challenges to OPEC plus stability. Russia's discounted crude sales to China may undercut broader efforts to maintain higher global oil prices. This trend strengthens China's role as a key player operating outside the US-led financial and trade framework. China is rapidly expanding its renewable energy sector, particularly in electric vehicles and LNG. As more Chinese consumers adopt electric vehicles and the government pushes for electrification in transportation and industry, future oil demand may decline. Moreover, China's energy partnerships with BRICS nations, Brazil, Russia, India, China, and South Africa, are central to its energy strategy, reducing reliance on Western suppliers. China maintains strong energy ties with Saudi Arabia. In 2023, bilateral trade between the two nations reached $17.23 billion, largely driven by oil exports. Beyond hydrocarbons, both countries are investing in renewable energy. Under Saudi Arabia's Vision 2030, half of the kingdom's energy is expected to be renewable by 2030. Chinese firms play a key role in this transition, including a $972 million deal signed in August 2024 for a 2-gigawatt solar farm. Financial collaboration has also deepened, with China selecting Saudi Arabia for its first sovereign bond issuance in dollars in 3 years. Following Western sanctions linked to the Russia-Ukraine conflict, Russia has accelerated its pivot toward Asia. By 2023, Russia-China trade exceeded $240 billion, with energy exports playing a significant role. In 2024, China finalized the Power of Siberia pipeline project, increasing its access to Russian natural gas. China and Russia are also negotiating the Power of Siberia 2 pipeline, which would redirect energy flows originally intended for Europe to China. Despite U.S. sanctions, China continues purchasing Iranian crude at reduced prices, providing Iran with critical revenue while securing affordable energy. In October 2024, the U.S. introduced additional sanctions targeting Iran's oil sector to curb funding for Tehran's missile programs. However, China's commitment to Iranian oil undermines these efforts and strengthens its energy security. China has also deepened its energy and trade ties with the UAE. In 2023, total trade between the two nations reached $95 billion, with non-oil trade growing by 7.55% over the previous year. Both countries are expanding investments under China's Belt and Road Initiative, particularly in renewable energy projects. In July 2024, China National Offshore Oil Corporation, or CNOOC, signed a strategic agreement with the Abu Dhabi National Oil Company, ADNOC, for joint crude oil and LNG exploration. China's growing reliance on Russia, Iran, and the UAE for energy supplies diminishes its need for U.S. oil, impacting American energy producers. Reduced demand for U.S. crude could lead to oversupply, price drops, and lower revenues for American firms, potentially affecting jobs and investment in the sector. Additionally, China's move away from the U.S. dollar in energy transactions threatens the petrodollar system, a pillar of American financial influence. China's gradual shift away from U.S. crude oil is a calculated move to secure cheaper, more stable energy sources while reducing reliance on Western suppliers. By strengthening ties with Russia, Iran, Venezuela, and the UAE, China is reshaping global energy dynamics and challenging the traditional U.S.-led economic order. These changes carry profound implications for global trade, energy security, and geopolitical alliances, signaling a new era of economic realignment beyond Washington's influence.